Welcome to the MedTech Wealth Advisor Podcast with your host, Matt Nelson. Matt, what fun, exciting things are we going to talk about today?
Yes. Yeah. We're going to talk about taxes.
Oh boy.
Oh boy. Oh boy. Yeah. We're titling this, 2024 important numbers. And so really just there's so much tax planning we could talk about, but we're just going to try to stick to, some of the numbers you need to pay attention to,
Okay.
coming up for this new year. So, last episode, um, we had just done our second in a series on restricted stock units.
Mhm.
And we'll finish up the third part of that series next episode. But being that we're kind of fresh in the new year here,
Yep.
thought this would be a good time to just cover a couple of tax planning numbers to be aware of, potentially things you still would have time to take advantage of for 2023,
Oh, good.
depending on the
Okay.
situation. And, the thing is, if you've listened to the podcast before, a lot of our clients, they have access to lots of benefits through work, like their 401k plans, their health
Mhm.
savings accounts, a lot of places to accumulate savings. And, a key component of financial planning and just building wealth is making sure you're on top of all those things. So, they're going to change year to year. Um, can seem straightforward, but some of this stuff is indexed with inflation.
Oh,
And
yeah.
so whether it's, contributions to your 401ks or the Roth limits, Medicare premiums, all that we got to talk about.
All right. Well, you remind me that I've got to start getting my act together here. So
Yeah,
launch into guiding everybody else how to get theirs together.
sure. I wanted to give you a quick example why this might be important. So, um, when when a potential client comes to see us for the first time, we have to gather a lot of data points on variety of stuff, variety of items. One of those items is usually their contribution level to their plan. So because we have to know that to
Yeah.
understand where they're going, that projection, make sure that's accurate. So, we might ask them, do you know how much you're contributing to your 401k? And they usually reply with something like, oh yeah, I'm maxing that out. But a lot of times we find out that they either aren't, or they're missing maybe the catch up contributions, or they just don't realize the limits have changed.
Hmm.
So for example, like in 2018, for people under 50, contribution limit to 401ks was only 18,500. Now that was up from years ago, but
Yeah.
now fast forward to 2024, that limit's 23,000. So it's a pretty big difference. Um, some plans, when you set up your contribution amount, you go in and set it as a dollar amount versus a percentage. It's less common, but it can happen. And so then people find people stuck on an old dollar amount. So that's what we're talking about, this like a real life example. But we're going to talk about three things: contribution limits, so to the vehicles, um, what those look like. We're going to talk about other income limits to be aware of. So do you qualify for saving to certain vehicles? Different items that have to do with Medicare and net investment income. So those are income limit related. And then the last one is standard and itemized deduction thresholds. So all areas that kind of tie together, but are important on their own. Um, I've got Jacob again with me. Thanks for joining again. Jacob's got a lot of expertise on the tax side, and so I'm going to kind of let him explain several things, go back and forth, because I think he does a good job at that. Um, so Jacob, welcome back.
Yeah, thank you. Thanks for the plug in there.
Yeah. um, let's start with the 2024 contribution limits, Jacob. So talk to me about that. Numbers dealing with like tax preference savings vehicles.
Yeah, I think a lot of this, when we meet with clients, it's, not everybody has cash flow to max out everything, all the options that are available. So, you might have a 401k and an HSA, and you might have a couple of Roth IRAs on the side if you're married. But does your cash flow really allow you to get to that point? So a little of this is kind of what we like to call an optimal order of operations, if you will. So, for example, let's just think of 401k, for example. Your 401k typically has an employer match attached to it. So contributing to there to at least get your match is pretty important because it's free money. But after that, there might be reasons that we want to hit things like a health savings account instead of just maxing out the 401k right away. Because a HSA is probably the most tax favorable account that you can save to, because you're getting a deduction on the front end. You can pull it out tax free on the back end. It almost acts like a Roth IRA, but for health savings. So there might be reasons to do the HSA before the 401k. Now we'll talk about some of the limits here, just to give you an example. So let's just say, you earn 100,000. Well, and if you have a 401k or a 403b, some people might have, for 2024 here, the max contribution, as Matt alluded to earlier, for those under 50 is 23,000. So you have 100,000, you knock 23,000 off the top, that's going to leave you with $77,000 of actual take home pay before tax. And then, your HSA contribution, if you are a married person and have a family health insurance plan, that limits $8,300 for 2024. So now you can see how if you max out your 401k and then your HSA, you're saving over $30,000, but your take home pay is really getting reduced. So now your cash flow has more limitations, if that makes sense.
Creates some choices, doesn't it?
Exactly. And it creates even more choices when you get over age 50, because now you have a catch-up contribution that you're allowed to make to your 401k. And for 2024, that's $7,500. So if you're over 50, you could essentially put $30,500 into your 401k plan. And then same thing on the HSA side. The HSA contribution looks a little different. It's tied to age 55 instead of 50, but that's an extra $1,000 to your HSA too. So if you're a family of a few and you have a family health insurance plan that qualifies for HSA, you could contribute almost $9,300 for 2024 if you're above 55.
Right.
So there's just a lot of cash flow decisions.
That's right. Yeah, it's almost like a waterfall effect. So what's most important to save to first, and then next, sort of waterfall that down. Because as you're alluding to, Jacob, if someone had, household income was instead 250, much different choices and tax effects. But so I think what I'm hearing you say, 401k went up to 23,000, catch-ups now are 7,500. And we've got the HSA you mentioned at $8,300 that you can go up to. Single or individual, I think, was 4,100. So what about for, the total amount you can put in a 401k?
Right. That's a really good question, because a lot of people, if you're working in the equity comp space, you might have, triggers that generate more income towards the end of the year. And then maybe you max out your 401k on a pre-tax basis earlier than you expected. So now you got to look at other savings avenues. So this would be for someone who maybe has excess cash to save to a different type of source. So a 401k usually has a pre-tax side, a Roth side, and sometimes an after-tax side. And an after-tax and Roth work very similar, but they get confused a lot too. So after-tax is not the same as Roth. After-tax money you put in on a after-tax basis, but the earnings after that are taxable, where with a Roth, the earnings are tax-free. So keep that in mind. But let's say you pull all three sources together, pre-tax, Roth, and after-tax, and then your employer also is contributing. That max this year, if you're under 50, is $69,000 is what you could put inside of a 401k plan, which is a lot of money. And then with a catch-up, again, you still get a catch-up contribution of $7,500. So you're saving, if you maxed out your 401k plan with an after-tax option, $76,500. That's a lot of money.
It's a lot of money. Yeah, it's been it hasn't been that long ago where I mean, it was substantially less than that. We had to do some special self-employed plans to get that high. But yeah, it's very, very beneficial now. If you're maximizing how the plan works, you'd be amazed how much you can pack into that plan. So
Exactly. Yeah. And one more thing, just on the 401k or 403b side, the 23,000 that we're referencing for under age 50, that is a combination of pre-tax and Roth. So it's not like you can do 23,000 to pre-tax and then 23,000 to
good
the Roth
clarification.
side. So it's very important that you pay attention to that. And a lot of times it comes down to what we look at when we're doing tax planning is, maybe you're in the 24% tax bracket, just barely. And our goal is to get you down to the 22. Well, maybe we'll do a little pre-tax to get you down to that 22% marginal rate. And then we'll switch over to, contributing to the Roth because it's a little more tax favorable that way. But those are all things that we'll look at.
Right. And actually it made me think of something we'll probably talk about in the next section about income limits. We could maybe even kick that off with the Roth eligibility. So there's limits, limits to how much income you can earn and still be eligible to contribute to a Roth IRA. And so why don't you talk about that,
Yeah,
how we might optimize what they're putting in their 401k to be eligible for the Roth.
exactly. That's a really good point. So a lot of times, if you're a high earner, we got to pay attention to these limits because Roth IRA money is super valuable, but not everybody can use it because of their income. So let's just use a client who maybe is married. Their gross income's about 300,000. Okay. Well, $300,000 in 2024 here would make them ineligible for Roth contributions. The Roth IRA phase out for a married couple is between 230 and 240,000. So there's some calculation in there that allows you to contribute if you fall between that range. But once you go over that 240, no more Roth IRA for you, at least directly. So what we might want to do is figure out a way to get your taxable income, or your modified adjusted gross income is what they really look at for this calc. But we need to get some deductions off that 300,000 somehow. And usually the best place to do that is with your 401k or HSA. So, if both of you and your spouse are above 50, you could each contribute 23,000 plus the $7,500 catch up. So you're over 60,000 going into your 401k, and then maybe a little HSA, and then you get below that $230,000 limit. So that's the things that we look at when we're trying to do that order of operations that I referenced earlier. It's like, how can we save to the right spots to then make you qualify for some other savings avenues that you may not have originally?
That's right. Yep, absolutely. So other income limits to be aware of. So we talked about how much you can put into these plans, but then again, what do we have to worry about from an income standpoint?
Yeah. So I think there's a few things. We just touched on the Roth IRA. There's also some traditional IRA deductibility limits that we have to pay attention to. So if, let's say, you didn't have an employer sponsored plan and your spouse didn't have an employer sponsored plan through work, which is very rare. Well, a nice way to get a deduction is contributing to a traditional IRA. So in that scenario, if neither of you have a 401k or an employer sponsored plan, you can always contribute to an IRA, a traditional IRA, and get a tax deduction. For those over 50 this year, you could each contribute $8,000. So a $16,000 tax deduction for a married filing jointly couple. But then it gets a little messy. Let's say if one of you is covered by a plan, but the other is not, then there's income limitations for your deductibility again. So that kind of falls back into that $123,000 range. So once you get above $123,000, your deductibility begins to phase out. And then once you succeed the 230,000, then I think that is when it totally wipes out. So there's a
Yeah.
lot of numbers to pay attention to there.
Lot of them. Yeah. And it's kind of confusing on a podcast, of course, when you can't
Yeah.
like, see them in front of you, but that just take away that there's going to be careful what vehicles you use as your income gets higher, because you're going to start to have phase out limits.
Yep.
Let's move on from the savings vehicle. So what different changes are we seeing in the Social Security and Medicare space for
Yeah. This
2024?
is a really big one, I think, especially for people who may be working still, but want to start collecting Social Security. So I'm going to start with that. So let's say you're 65, still like your job, want to earn a little money, but also want to start collecting Social Security. Well, that might not be the best option, because pre-full retirement age, so Social Security has a full retirement age, and most of us now are going to be between that 66 and 67 age, is what they define as full retirement age. If you earn money before full retirement age and collect Social Security, you're actually going to be losing money because there's an income limit tied to it. So Social Security right now only wants you to earn $22,320 if you're pre-full retirement age. Otherwise, what they're going to start doing is deduct $1 of your Social Security for every $2 you earn. So once you get above that $22,000 mark, they're going to start taking your Social Security back from you, which sounds like robbery, but that's how they get you.
Right. And there is some amount of that being added back into the mix because they're collecting tax on that. But in the end, it really messes with your cash flow, what you were planning on. It's not an optimal way to do it. Let's put it that way. On the other hand, don't let it. It's a consideration, but if you have the right situation with the right job or cash flow needs, it can be okay to do. But there's definitely considerations there for how long will it take to make that back up.
Exactly. Yep. I think that's probably the biggest thing is just pay attention to these limits and then ask questions where you need to.
Right. The big one that I want to talk about for sure when it comes to Social Security and Medicare is something we refer to as IRMA. So that's our acronym for it. Stands for Income Related Monthly Adjusted Amount. And if you're not collecting Medicare, you probably don't know what this is. But I just about assure you, if you're collecting Medicare, you've heard of this. Maybe not. But tell us about this, Jacob. What do we have to pay attention to here?
Yeah. So IRMA and Medicare, they go hand in hand, just like Matt was saying. The tough part to remember is Medicare premiums work on a 2-year trail. So for 2024, you won't really feel the effects of your income associated to the Medicare premiums until 2026. So your 2024 income will impact 2026 premiums. And it's all income based, like Matt was saying. So for instance, in 2026, it's currently estimated that if you're single and had income over 108,000 for 2024, that's where that first threshold is going to kick in, meaning you're going to pay more than what you should be for Medicare. Sometimes you can't always control that because you have different income streams during retirement, like pensions and other things like that are good to have. But yeah, you'll end up paying more in Medicare. So sometimes we need to do some tax planning. So if it turns out that you're still working and we can get some deductions on a 401k to keep your Medicare premiums lower in a couple of years, we're going to try to do that.
Yeah,
So
absolutely. The point of it is that IRMA is designed to be need-based or income tested based. But look, it's one thing to pay the taxes you owe and Medicare premiums you owe, but you don't have to pay more than you owe. And if there's strategies around that to avoid giving Uncle Sam a tip, so to speak, might as well do that. If you got other income that you could accounts you could spend from, push off pension plans, delay Social Security, whatever it is, and be at the lower Medicare premium for a few years, why not do that?
Right. Exactly. And I think the other one that we see a lot, especially in the equity comp space, is just, when you sell an investment like a stock, you're going to have to pay capital gains more often than not. So there's three levels of capital gains. There's 0%, there's 15%, and then there's 20%. So if if possible, we might want to delay selling certain investments until a year where we can control that income stream a little better. So if you're working, for example, and you have a $400,000 income that year, and then you sold an investment at capital gains, you're going to be paying 15%. But if next year you're planning on being retired and have no earned income, well, maybe we can get some of those capital gains out at a lower rate, like 0%. So that's a big tax move.
Right. Right. And those levels moved up this year, the income limits on where the capital gains brackets change.
Exactly. So let's just focus on a married couple here. Until you hit $94,000 of income, you'll pay 0% on capital gains. And then anything between 94 and 583,000 is 15%. So that's a really wide range,
Huge range.
which gives some flexibility. But then you get above 583,000, we got to deal with 20%. So some tax planning is always involved when we're looking at that. And then on top of that, there's this thing called net investment income tax. And this limit is it's an additional tax. You can think of it as an additional tax on the capital gains that you're selling. And that one is only at $250,000 for a married couple. So you would have to pay an extra 3.8% if you were above that income.
Right. Yep. And these income, they don't apply to everyone. And but when we're dealing with equity comp in compensation plans, you can easily have a year where you spike, way up above 500,000, especially if you have a $200,000-$300,000 salary and you have a giant comp year. So that's why we're bringing this into play and talking about it. Well, Jacob, just for time, I want to make sure we have a little bit of time to cover the standard deduction and the itemized deduction section.
Yep.
And why that's important to pay attention to this year.
Yeah. This is a really big one, especially even with equity comp clients, because sometimes there's going to be moments where you want to gift it away to a charity or something similar, but there's limits involved with gifting to charities, and we got to make sure we're accounting for other deductions at the same time, because the last few years since 2016, really, the standard deduction, as most people know, has just been really big. And it's harder to itemize now than it was prior to 2016 because of the Tax Jobs and Cuts Act. So married file jointly in 2024, your standard deduction is almost 30,000. It's 29,200. And the way that works, remember, is if you gift to charity for 10,000 and then you have some state taxes that are capped at 10,000 now, and then medical of 5,000 only, you're not getting any benefit for your itemized deductions because you're just going to use the standard deduction.
Right. And so just to make sure, say that a different way, or to remind people how this works, if you don't have more in itemized deductions than your standard deduction, then you use the standard deduction. And if you don't have substantially more than the standard deduction, it didn't do you a lot of good anyway. So kind of what you're saying, Jacob, is if you're going to do a charitable contribution, you should probably do it big, like do a large one in 1 year, group together multiple years. Maybe see if you can also find some other things you can itemize that year. Maybe it's some medical costs that you have. Just go through all the different itemized deductions you come up with and put them all in 1 year, and then do your charitable.
Exactly.
Otherwise, you might not even get a benefit. It doesn't mean you shouldn't give to charity. There's other reasons we give to charity. But look, at the end of the day, if you're going to give your church or your other community organization 10 grand a year and you do that every year, well, you should just do 30,000 in 1 year and actually get a benefit. And there's still a way, we can talk about it in a different episode, but there's still a way to get the tax deduction in 1 year, but dole it out over 3. We'll talk about that in a different episode.
Exactly. Yeah. A lot of times, we might have a client come to us at the end of the year saying, hey, I need to give X dollars to my church or any other organization. Well, a follow-up question that we might have is, okay, do you have any big medical things this year already? Or do you have any big ones planned for next year? Because what we want to do is bunch those deductions all in 1 year so you get a bang for your buck, essentially.
That's right.
The key ingredient, though, especially when we're talking about gifting stock, is this 30% of AGI limit. So when you gift cash or things like cash equivalents, you can pretty much deduct whatever you want. But when you're gifting an appreciated stock to a charity, there's a limit of 30% of your AGI. So, for example, if your AGI was 200,000 and you gifted 100,000 of capital gain stock, you're only going to get a benefit for 60,000 because of that 30% rule. So we got to pay attention to those, because maybe it would be better to, okay, use that 30% this year and then do, 40,000 next year instead of all 100,000 at one time.
Right.
So,
right.
Yep.
Lots of little traps you can kind of fall into if, you're headed the right direction. Directionally you were right, but you missed the limits and then didn't really get the benefit you meant. So take some good planning with an advisor, whether it's us or a CPA, but make sure you do that. This was all good stuff, Jacob. I mean, there's a lot we could kind of, go on about for numbers, but I think we'll leave it there today. I mean, that's some good info. I mean, at the end of the day, look, if you don't want to miss out on all the tax deductions and just the opportunities you have available this year, 2024, you just need to pay attention to the retirement plan contribution limits. Make sure you pay attention to the income eligibility limits. Make sure that you, qualify. And then, the last one, check out the standard versus itemized deductions and make sure those are what you're doing there is coordinated. So you're getting the deductions you really are expecting you're going to get. Bill, I think we'll leave it there. We do have some resources on our site. And so if listeners want to check that out, Jacob wrote an article titled Key Retirement Plan Contributions for 2024. So check that link out. That'll reference all the numbers we brought up here. I think there's also a link there to a guide called 2024 Important Numbers, and that'll break down really all these numbers. You could print it, have it as a reference for this year.
Yeah, no, that's great. That's great to know. In fact, it's somewhere in the middle of all those numbers. I was thinking there's got to be an article that you can reach out to, because I was imagining somebody listening to this in the car thinking, I can't write these numbers down, man. I can't do
sure.
Yeah.
Right. Eyes rolled back, trying to remember. Yeah, no, I get it.
I don't think we caused any car accidents. Okay.
Yeah,
But you may have given some people some anxiety. Okay.
That's right.
So for people who want to reach out to you and give you a call, maybe have a conversation with you, what is the best way to do that?
Yeah. You can give us a call. Happy to talk to you, give you a second opinion, talk through your situation. Number's 952-225-0333. You can also check out the website. It's perspective6group.com. The number
and
6.
That is the number 6, right?
Number 6.
Number
That's right.
6.
That's right.
Right.
Check us out there, get a little information, articles, like I said, on the website. Next episode, we're going to jump back and finish up the third in our series on RSUs, on restricted stock. But until next time, Bill, what do you usually say when we close out?
I usually say this: for those of you who are not already subscribed to this podcast, hit the subscribe button. That's easy to do. That way you never miss another conversation of this podcast. And I'm sure you don't want to do that. And I would also ask that if you like it, tell people about it. Share it with people. Spread the word about the podcast. Get the word out there. And in the meantime, I am the producer, Bill Tucker, on behalf of Matt and everybody at Perspective 6, urging you to go out and have a great day and do it today. Or not. I mean, it is your choice. Thanks for listening.